What's up, everyone? It's Tana Kid, and let's talk about inflation. You hear about it everywhere, but what does it actually mean for your money? Inflation is like a sneaky tax that silently eats away at your hard-earned cash. Think about it. That $100 you have today won't buy you the same amount of stuff next year, or even next month. That's why we're diving deep into how to inflation-proof your finances. We'll cover smart investment strategies, asset classes that tend to do well during inflationary periods, and actionable tips to help you stay ahead of the curve. Let's get started. One of the most talked about ways to hedge against inflation is by investing in real assets, and real estate is a perfect example. Why? Because as the cost of goods and services goes up, so does the value of that tangible property you own. Think about it. As inflation rises, so do rents. If you own rental properties, you can increase the rent you charge, keeping pace with inflation and even coming out ahead. And even if you're not ready to become a landlord, REITs, or real estate investment trusts, offer a hands-off way to invest in real estate without actually owning physical property. Now let's talk about precious metals. Gold and silver have been considered safe haven assets for centuries, and for good reason. They're tangible assets with intrinsic value, meaning they have worth in and of themselves, unlike paper money. Historically, when inflation rises, the value of precious metals tends to hold steady or even increase. This is because investors flock to these assets as a way to preserve their wealth during times of economic uncertainty. Investing in real estate or precious metals isn't about getting rich quick. It's about playing the long game and protecting your purchasing power over time. If you're looking for a way to diversify your portfolio and hedge against inflation, real assets like real estate and precious metals are definitely worth considering. However, it's crucial to remember that every investment comes with its own set of risks. Before diving into any investment, it's essential to do your own research, understand the potential downsides, and consider consulting with a financial advisor to make sure it aligns with your overall investment strategy and goals. Remember, diversification is key. Don't put all your eggs in one basket, even if that basket is filled with gold bars. Let's face it, inflation can be a real buzzkill, eroding the value of your hard-earned money over time. But fear not, because in this chapter, we're going to explore some powerful tools to fight back inflation-linked securities. First up, we have TIPS, or Treasury Inflation-Protected Securities. These bad boys are issued by the US government and are designed to protect investors from the eroding effects of inflation. Here's how TIPS work. The principal value of a TIPS bond adjusts with inflation, as measured by the Consumer Price Index, CPI. So, if inflation rises, the principal value of your TIPS bond increases, and when inflation falls, the principal value adjusts downward, but never below its original face value. Next, we have I-bonds, another type of government savings bond that offers a compelling way to protect your money from inflation. I-bonds have a fixed interest rate that remains constant for the life of the bond, plus a variable interest rate that changes every 6 months based on inflation. This combination of fixed and variable interest rates makes I-bonds a potentially attractive option for investors looking for a safe and predictable way to earn a return that keeps pace with inflation. Now, while inflation-linked securities can be fantastic tools for preserving your purchasing power, it's important to remember that they're not a magic bullet. Like any investment, they come with their own set of advantages and disadvantages. One of the main advantages of inflation-linked securities is that they offer a relatively low-risk way to protect your money from inflation. They're backed by the full faith and credit of the US government, which means they're considered to be extremely safe investments. However, it's important to note that the returns on inflation-linked securities may be lower than other types of investments, especially during periods of low inflation. Overall, inflation-linked securities can be a valuable addition to a well-diversified portfolio, especially for investors looking to protect their purchasing power over the long term. Remember, before making any investment decisions, it's always a good idea to consult with a financial advisor who can help you assess your individual needs and goals. Chapter 3. Now let's dive into a potentially more lucrative, albeit slightly riskier avenue to combat inflation: the stock market. Sure, the stock market can be volatile in the short term, but over the long haul, it has historically outpaced inflation, making it a powerful tool for building wealth. But here's the key. You need to be strategic about the types of stocks you invest in during inflationary periods. Look for companies and sectors that tend to thrive when inflation rears its ugly head. Think energy, consumer staples, and utilities. These are industries that provide essential goods and services that people continue to need regardless of the economic climate. Energy companies, for example, benefit from rising oil and gas prices, while consumer staples companies that produce everyday necessities like food and household products can often pass on price increases to consumers. Utilities, with their relatively stable earnings and necessity in our daily lives, also tend to hold up well during inflationary periods. Another smart move is to consider dividend-paying stocks. These companies distribute a portion of their profits to shareholders, providing you with a steady stream of passive income that can help offset rising costs. Remember, investing in the stock market is a marathon, not a sprint. It's about staying the course, riding out the inevitable ups and downs, and letting the power of compounding work its magic over time. However, it's crucial to approach the stock market with a healthy dose of caution and a well-thought-out plan. Don't fall into the trap of trying to time the market or chase after the latest hot stocks. Instead, focus on building a diversified portfolio of quality companies that align with your long-term financial goals. If you're unsure about how to get started or want to ensure your investments are aligned with your risk tolerance, consider consulting with a financial advisor. They can provide personalized guidance and help you navigate the complexities of the stock market. Chapter 4. Let's get real for a moment. When inflation soars, the prices of everyday goods and services tend to follow suit. That's where commodities come into play. Commodities are raw materials or primary agricultural products that serve as the building blocks of the global economy. Think oil, natural gas, gold, silver, wheat, corn, and soybeans. Now here's why commodities can be a valuable addition to your inflation-fighting arsenal. When inflation rears its ugly head, the prices of these raw materials often rise as well. Think about it. As the cost of production increases due to inflation, companies are often forced to pass those higher costs along to consumers, driving up the prices of everything from gasoline to groceries. Investing in commodities can be a way to potentially profit from these price increases. There are several ways to invest in commodities, including futures contracts, ETFs, and mutual funds. Now, let's shift gears and talk about a more modern asset class that has been gaining traction as a potential inflation hedge: cryptocurrencies, particularly Bitcoin. Bitcoin, with its decentralized nature and limited supply, is often seen as a digital form of gold. Unlike traditional currencies, which can be printed endlessly by governments, Bitcoin has a fixed supply cap of 21 million coins. This scarcity is one of the key factors that attracts investors looking for an alternative to traditional fiat currencies, especially during periods of inflation. However, it's essential to approach cryptocurrencies with a healthy dose of caution. The cryptocurrency market is still in its infancy, and prices can be incredibly volatile, experiencing wild swings in short periods. If you're considering adding cryptocurrencies to your portfolio, it's crucial to do your research, understand the risks involved, and only invest what you can afford to lose. Remember, diversification is paramount. Don't put all your eggs in one basket, regardless of how promising an asset class may seem. Chapter 5. Now let's talk about some personal finance strategies that can help you navigate the choppy waters of inflation. One of the most effective ways to combat inflation is to invest in yourself. That's right, you heard me correctly. Invest in you. Think about it. As inflation eats away at the value of your money, your earning potential is one of your greatest assets. By acquiring new skills, expanding your knowledge base, or pursuing additional education, you can increase your earning power and stay ahead of the inflation curve. Consider taking online courses, attending workshops, or pursuing certifications in your field. The more valuable you become to employers, the better positioned you'll be to negotiate higher salaries and maintain your purchasing power. Now, let's talk about debt. Inflation can be a double-edged sword when it comes to debt. On one hand, inflation can make it easier to pay off existing debt if you have fixed-rate loans. Think about it. As inflation rises, the real value of your debt decreases. That means the monthly payments on your fixed-rate mortgage or student loans will stay the same, but the purchasing power of those payments will decrease over time. However, on the other hand, inflation can also make it more expensive to take on new debt, especially if interest rates rise. That's why it's crucial to manage your debt wisely, especially during inflationary periods. If you have high-interest credit card debt, prioritize paying it down as quickly as possible. Consider consolidating your debt or exploring balance transfer options to potentially secure a lower interest rate. Remember, managing your finances effectively during inflationary times is all about being proactive, making strategic decisions, and staying informed about the economic landscape. By investing in yourself, managing your debt wisely, and making informed financial choices, you can weather the storm of inflation and come out stronger on the other side. Look, inflation is a fact of life, but that doesn't mean you have to let it erode your hard-earned money. By diversifying your investments, considering real assets, and making smart financial decisions, you can protect your wealth and even come out ahead. Remember, knowledge is power, and the more you understand about inflation and its potential impact on your finances, the better equipped you'll be to make informed decisions that align with your long-term goals. If you found this video helpful, hit that like button, share it with a friend who could benefit from this information, and subscribe to the channel for more practical financial insights. Until next time, stay informed, stay invested, and stay ahead of the game.